Hey, welcome to the live stream. It is Sunday evening and it is August 4th, August 3rd, excuse me. And tomorrow will be August 4th, Monday. Trading begins, and we've got a long list of companies that are going to announce their earnings. This week, the companies may be small market cap, but we've got probably just as many or more. If you just look at Monday, we have 138. Tuesday, 306. Wednesday, 393 companies reporting. Thursday, 454. And then Friday, 91. So we've got a lot of companies reporting this week, and we will address the ones that are reporting tomorrow. We'll take it one day at a time. Got plenty to talk about, and we'll address Tuesday's companies probably tomorrow night and maybe Tuesday morning. We'll see. So thanks everybody for joining. It looks like we've already got people in the stream. Thank you so much for joining. Hopefully you are seeing this sell-off that we've had as an opportunity. The past week has been a negative week. If you look at the 5-day, we're down on the S&P 2.46%. And a lot of the selling really happened starting on Thursday. Thursday was a kind of a weird day. You know, the market traded up and then it came down. So altogether, most of the loss came on the last 2 days of trading of the week. So we kind of faded toward the end, especially on Friday. Friday was a real bad day. One day on the S&P was down 1.6. The NASDAQ was down 2.24%. Hopefully it isn't ugly for a while like that, but maybe it will be. If it is, it's an opportunity because the market is expensive. It's really doing well over the long haul. You've seen some stocks get really expensive, and we had a big correction in April. We came back in a fury, just came back strong, and now we're giving up some of those gains. We've just begun to give up the gains, so nothing to worry about at this point. Let's just keep at it, continuing to research the companies we think are really good companies. And what the market will show us is, depending on the company, I'll come up with a well-known company. Let's go with Meta. I use this example a lot, but I could easily show you 10 companies. The market will sell stocks off. Usually when we have sell-offs, the market acts irrationally when it's selling off, and it acts irrationally when it's going up. In the case of Meta, it sold the stock off by 76%, and since that low point, Meta's up 726%. It's the same company. It's not like they change companies, change businesses. No, it's the same company. So we just got to stay at it and be patient, be smart, work on analyzing these companies, and go at it the right way so we can make a very good amount of money over the long haul. For those that are new, and it looks like Bushy, good afternoon. Good to see you. Thanks for joining. Let me know if there's a stock out there you want me to research and look at. For everybody else, if you're new to the channel, I have a long-term strategy. I like to look for good companies that I think are overall good businesses to have, very desirable businesses defined by very strong moats and their ability to grow their cash flows, grow their profits. And I want to buy them at a discount. You know, I just showed you one of the best names on Wall Street, and the market will discount it. We just have to be patient, be ready for it. They discounted it there. Very recently, it discounted it here. Very easily, you know, if you're really wanting to get into Meta, you could have got in April and you'd be up close to 50% in a couple of months. So the market will do that. We just have to be persistent, you know, use time in our advantage. So if we do our research, we know what companies are valued at. we stick to trying to buy under intrinsic value. So as we look at stocks today, we'll try to define what the intrinsic value is for those companies. Looks like Elon is on the stream. Good to see you. You're interested in Robinhood. I did a video on Robinhood. It's on my channel. And Robinhood announced last week. Interesting that their stock in the after hours gave up a few points, but then it came back the next day. Then it sold off with everything else on Friday. So I think Robinhood's holding it together. I really like that stock. Watch the video and you can have about 12 to 14 minutes of my comments on Robinhood. Thanks for joining. Thanks for asking about Robinhood. All right, so as we approach the week, we've got the earnings. That's going to be number one on the plate of information coming through. We had Berkshire Hathaway, and they do things differently, and it's kind of common sense. They released their financials for the quarter, the second quarter. I was able to analyze those financials, and I actually created a video on it and released it. And that business is it's not for everybody. Some people really investing in a very well-run business. For a long time, it was run by two of the greatest investors of all time, Warren Buffett, Charlie Munger. But Warren Buffett's passed the reins over to the successor, and I'm sure he's really good. So he's going to take over. But the stock hasn't really been doing all that great this year. It's up 4.32%. The S&P is up about 6%. So it's lagging the S&P just by a little bit, but you would expect that Berkshire would be doing well. And really the sell-off started when it was announced that Warren Buffett at 94 is turning things over to his successor. It shouldn't be a giant surprise. He's 94, so we should have expected it for a while. One funny story is I was listening to an interview of somebody who's actually went to a investor meeting for Berkshire like 25 years ago, and he was younger back then, and he was really excited about it, and he was able to get to the podium and ask a question. And his question 25 years ago, Mr. Buffett, can you talk about succession planning and when that's going to happen? 25 years ago, and it finally happened 25 years later. So he got his answer. They took action. It just took a long time. And 25 years ago, Warren Buffett was 69 years old. So even then, people were thinking, okay, he's not going to be around forever. But boy, he lived a long life and he was really successful. Go Warren Buffett. So this company is a $1 trillion market cap company, and their revenue is $371 billion, 3 times the revenue. The P ratio looks pretty decent. Analysts think it's discounted. It's been selling off. It was a $539 stock, call it 3 months ago, and now we're down to $472 a share. So it's lost some value in the last 3 months. The company is not growing all that fast. It's pretty much flat if you look at 2024 and then the trailing 12 months. And strong balance sheet with a lot of cash. They do carry a lot of cash, and they're deal makers when other businesses start struggling. Berkshire will offer them, capital, liquidity, but they'll do it with terms that are going to really reward Berkshire Hathaway. Not sure when that's going to happen. I don't think a lot of companies are struggling right now, but if we had another great recession or something like that, Berkshire Hathaway would be setting themselves up to make a lot of money. I assure you of that. I created a valuation for Berkshire. Now, they released their financials, and what's interesting is their earnings call will be Friday. So they give the market a whole week to study their financials, and then they'll have an earnings call on Friday. I believe it will be the first earnings call that will be the successor, the new CEO will lead that particular meeting. And when I looked at Berkshire, I analyzed the company yesterday, and my analysis is updated. I think the stock is being priced at an 8% discount right now, primarily because they are going to be more profitable going forward. But their free cash flows are about 5% short of where the company stock price is currently. When I look at their free cash flows that I expect, and I give them a very low discount rate of 7.5 because it's Berkshire Hathaway. It's really solid. Balance sheet's good. All those things look really good. And I'm growing their free cash flow by 7%. I think that's very doable the first 4 years. And then after that, 4%. Well, I get a net present value of the cash flows of 590, call it 96 billion. You got to add the cash and equivalents. Then they have a lot of stocks they own. So I added those. And then I took away debt. I get $968 billion of value. If I use the free cash flow, the discounted free cash flow method, and add assets that should be added. So we're close, but it's a 5% premium. And based on profits, this is what is normally found on websites, but it's less preferred by investors, long-term investors. We want to look at free cash flows. But looking at earnings per share, discounting earnings per share, it gets to about 6% discount on stock available. And when I blend the two, I think it's about an 8% discount. Now, Berkshire doesn't have a ton of momentum, so I'm not sure that's a great discount for a company. I think there's bigger opportunities out there, or maybe if I'm patient, maybe the stock price keeps going down. Maybe I could be offered like a 25% discount on Berkshire, or maybe a 30. Then I'd be a buyer at that discount level. So that's a big name that came out this weekend, Berkshire Hathaway. Analysts, only 2 cover this, very famous company. Just a lot of people want to avoid reviewing Warren Buffett's company. And you got analysts like on Facebook, there's like 40 analysts that are willing to weigh in. The one analyst is at $591 a share. The other one's at $465. Interesting. One second, guys. Sorry about that. I was being asked something. I just provided some information. All right. So the analysts are one is close. He's just a little bit, bearish, I guess. And the other one is optimistic. Can't blame him. 2 analysts only cover the stock, but more analysts weigh in on their growth. You got 6 analysts weighing in on how the company's going to grow. It looks like this year they're going to be flat. Next year they're going to grow by 5%, then come down. So not a really exciting business. So that is Berkshire. We'll see how they do going forward. I mean, right now, for the last, 5 years, it's been technology, communication services, it's been AI, a little bit of crypto mix in there. Just some fantastic opportunities. And, Berkshire's been kind of slow and steady. And for a long time, they've just been a winner. But I don't know that they're catching a lot of attention right now. I don't know that a lot of investors are going to really flock to Berkshire anymore now that Warren Buffett's not going to be around. But we'll see. Looks like we've got more comments coming in. Ian, TLT or GDX? I'm not sure. I don't really cover those ETFs. So TLT, it's a treasury bond ETF. I could weigh in on this. I like bonds, especially right now. When all stocks are selling off dramatically, bonds become cool. And then compared to gold miners, oh man. So This is the Treasury bond ETF. You get paid a nice dividend, pretty much the yield on those bonds. This is a 20-year, so these are long-term bonds. This is up 0.56%. You add it to that yield and you're close to 5%. That's what bonds do for you. Now, here's the thing is I'm not an economist, but I believe that interest rates are going to fall because President Trump wants lower interest rates. I think he's really trying to influence the Fed to lower rates. Now, the Fed doesn't lower long-term rates, but so long as there isn't any problem with the United States, I think long-term rates will come down. And if they do, this bond ETF will probably do better than 0.56, but it's not going to be like, oh, it's going to go up 30%. It might go up 5%. Then you'd be sitting on a close to 10% rate of return on a bond fund or ETF. So that'd be phenomenal. So this one looks good. Now let's talk about gold miners. Gold has been terrific. For the past year to date, this thing's up 54%. And this one's up 38% for the 1 year because it had a sell-off. Now, is gold going to continue to rise? Man, that's a tough one. I don't see any big problems on the horizon. And gold does well when there's problems. So long as the tariffs kind of get resolved, I think that one's going to be okay. Man, these are two different investment vehicles. I don't invest in gold. I've never invested in gold. It kind of doesn't make sense to me. It makes sense to others. And if it makes sense to you, go for it. For me, I'd probably go with the TLT. I don't own it, but I'd probably go with the TLT. I have a long-term bond ETF, but it's more of corporates, and I do better than 5%. So that's my preference there. Good question. Good question. It's good to talk about bonds right now because stocks are just getting hammered. Dre the Great. I work for BHE, hoping for the best. Only two what? I'm not sure what your comment there is. Only two. And what is BHE? Benchmark Electronics. So these guys offer product design, engineering services, technology solutions. All right. Okay, cool. So you guys are like a design center. You have designers, engineers, technologists. Cool. Looks interesting. Very professional services oriented, I imagine. Market cap 1.35, revenues 2.59, PE is 36. Strong buy. So revenue's been declining for a couple of years, and the trailing 12 months is in the red. So it'd be good to see it begin to go in the green because that's one of the key data points that I like to see is good revenue growth. Good revenue growth means customers like the product or service. They're buying more of it. New customers are becoming customers because that's a good business. So seeing negative numbers is not a good thing. I'm going to expect that margins are low. They are. The reason for it is this is a professional outfit where when they get a contract and do the work, they have to hire a lot of professional people, pay them well, good benefits and so forth. So it really takes a lot of the margin away. It's not like Meta, Facebook, they create this platform and people use it 24/7. It's not like they have people behind that platform responding to messages and stuff. No, it's pretty much running on this, big infrastructure, and it's a very high margin business. It's a very low margin business, which is why the market cap's 1.5 billion. Looks like it's a good company, but it's just a different type of company, professional services oriented. So they announced on July 30th. What happened on July 30th? I think it sold off a bit. And it came back. So hopefully it stays steady. But good luck. I hope your revenues start growing. Good to have you on the stream. Thanks for coming. Antoine. Looks like you're asking Dre a question. Cool. Cool. Yeah, you're welcome, Antoine. To have I like streaming, and I really enjoy investing, especially as the markets sell off or as they rally. It's almost like rallies are less comfortable than sell-offs because I'm always in the mood to finding really good businesses that are really discounted. When you have these sell-offs, you can find those. When you have these rallies, it's like, man, I can't find any good discounted businesses. But my portfolio looks a lot better on rallies. Oh, only two catalysts. Yeah. Yeah. So, one thing, and I see Mitch is on there. Hey, Mitch, I'm gonna get to your comment next. Just to put kind of like a final comment on Berkshire. One thing that I would say is Berkshire owns a lot of utility companies. Probably about they do about $5 billion in revenues from utilities out of a pretty big number. So looks like their revenues 371 billion. So 5 billion of that is utility companies. And utility companies are red hot right now. The AI uh, the AI wave consumes a lot of power. Those GPUs are just power hogs. So these utility companies might be worth a lot more, right? If those utilities can all of a sudden raise their rates, they're still doing the same thing, but now the power has more demand for it. And you raise your rates, more profit. Maybe that's going to be a profit catalyst for them. That's one thing that I pointed out. They have a railroad business, they have a big insurance business. So insurance, judging from Allstate and Progressive, they both announced really good earnings. So I'm sure their real estate, their insurance business, which is Geico, by the way, that's the Berkshire-owned company. I'm sure it's doing well. And they don't announce earnings because it's privately held by Berkshire. So all that looks good. And then the last thing is, their cash pile. If we do have some type of bad event like we had here in April, we did correct very quickly, or recover, I should say. But if we had a prolonged like bad recession or bad moment like the Great Recession, these guys are going to clean up because they'll go in and buy, debt on 20 cents on a dollar. They'll provide liquidity to a company, but they'll get preferred stock with a really high dividend rate. They just get really, really good terms when they bail companies out. So if any of that type of activity comes up, it's really going to benefit Berkshire. All right, Mitch. So let's take a look at your comment. And good to see you. Would be interested on your take of toll road companies like ASR and FER. Yeah, let's take a look. I don't know that I've looked at a toll company. I have a toll company near me. I should say we use the tolls in my area in California. I'm not sure who owns those. So FER. So ASR, and I'm gonna guess these guys they're gonna act like they're gonna act like a real estate investment trust. And I took your symbols here, ASR and then FER. So this is Grupo Aeropuerto de Sureste. And quick profile on these guys. These guys are in Mexico. They do airports. So am I looking at the right company? So you're talking about a toll company. And I'm not sure I'm looking at the right one. Okay, so I'm on the right track here. So these guys, it looks like they run an airport and maybe some other infrastructure. Okay, so they operate airports down in Mexico. They lease space on airport properties. They also operate airports in Colombia. Okay. Okay. So $9 billion market cap. This is in US dollars, almost $2 billion in revenue. PE looks pretty reasonable. They pay a high dividend. That looks good, 7.6%. Year to date, up 18%. So the 1 year is decent, sort of. It's up about, if you add these two together, you're up around close to 9%. The year to date looks fantastic. Why is the year to date so good? We came out of April, everything was sold off. It really rallied up. It settled down. Okay, so that dividend looks good. Can they afford it? So they pay it semi-annually, twice a year. And this doesn't make any sense. The payout ratio would be 1,051%. I'll look at their cash flow yield and compare it to 7.6. Okay, so they're growing. God dang, look at that. This is an airport. What are they doing growing this fast? That looks really good. I mean, I would have thought, they grow like 2%. Like we saw Berkshire, they're not growing. Here's an airport, they're growing fast. I can understand coming out of 2022 because nobody was traveling and then bam, you grew. But if you look at before COVID, they were doing about 16.8 billion in revenue. Now they're up to 34, so more than double. So there's been some good organic growth. And the profit looks good. Okay, that looks great. So free cash flow, almost $10 billion. Okay. And the gross margin 60%. I guess because you own the airport, and I don't know how airports function, by the way. I fly all the time. I buy my tickets. I know there's a bunch of taxes there. I think in those taxes, it's almost like you pay a certain fee, but they already built the airport. It's not like they're doing much for that fee. So I guess that's why it's so darn profitable. But I'm really impressed. Geez, that's really good. So I really like the margin. You're not going to get competition. If you have an airport, I think there was one in Cancun, right? It's not like another company's going to say, wow, hey, that airport in Cancun is really profitable. I think I'm going to build one across the street. No, it doesn't work that way. These things are big infrastructure projects. They just wouldn't allow it. They're like, no, it has to serve that particular area and all the commerce that needs that airport. We don't want to overbuild airports because the last thing we want is two airports that go bankrupt because they were competing against each other, probably. So one thing I'll point out, trailing 12 months cash flow is 10 billion. The market cap of the company is 9 billion. Okay. That's like really high free cash flow. And this is Mexican pesos. Yeah, okay, that's where I'm missing. So that's a Mexican pesos. So Mexican peso to USD, it's 0.05. Okay, so we can convert that. Okay, so when we look at 10 billion times this, that's going to end up being like 500 million. So let me do a quick calculation there. And yeah, 530 million. Okay. And based on their market cap, that's going to be about about 6% free cash flow yield. So that dividend is a little high. The dividend of this dividend's a little high. Their free cash flow yield's about 6%. So where the rest of the cash is coming from, maybe there was a one-time dividend that they had excess money after several years, and they're like, hey, let's give it back to the stockholders. So this is not sustainable, in my opinion. Okay, so we got a good cash flow yield. You've got good gross margins. Let's look at the net margins. So profitability is good, real good. Yeah, this is a good, profitable airport. So the margins look good. The growth looks good. Free cash flow looks decent. If we looked at that free cash flow, you can value the company at this level. Maybe you can value it even higher. But let's take a look at the balance sheet, because all this could be for nothing if the balance sheet's terrible. And a terrible balance sheet means you carry too much debt. In this case here, they have $1.05 billion of cash and about the same amount with debt. This is a quality balance sheet, no debt. Very good job. That could have really spoiled the whole thing, because if you have really good numbers like that, but then, well, this thing's got too much debt, pass. So this looks really good. This looks really good. Let's kind of crack this one open and kind of look inside by putting it into a valuation model. And I'm going to compare it. Believe it or not, I don't have any airports that I've valued before. So I'm going to compare this one to Union Pacific. Union Pacific's not an airport. It's a train. It's a railroad. So it's transportation. It's somewhat related. So we will make room to put a copy of the valuation for Union Pacific. And then we will do a valuation on that stock based on free cash flows and as well as their earnings per share. This is a good one. Man, thanks for bringing it up. I like when we live stream and we get, I don't know what happened here. What happened here? That didn't look right. There we go. That looks right. Okay, good. So I like when we live stream and you guys bring up ideas that I don't think about, because I don't think about everything. But then we get cracking into these and I'm like, geez, never thought an airport would look this good. I mean, it looks good so far. It's almost like it looks good enough to keep analyzing. We're not done yet, right? Got to do our homework here. Got to go all the way. ASR is the symbol. And the name is a little long, but no problem. All right, so this airport is down in Mexico, and there's a higher risk, right? In the U.S., I live in the U.S., totally comfortable with, companies in the U.S. Down in Mexico, I want a higher rate of return because I'm going to take a higher risk. Don't know a lot of the customs, a lot of the business customs that are handled down in Mexico. So I'm going to go all the way to 11, okay? And delete the RSI. I don't really care about RSI. All right, I'm going to leave the growth alone for a minute. We arrived at $530 million of cash flow. And I'm going to grow that cash flow. I'm going to look at their revenue growth and then establish what I think the growth rate will be for the next 4 years. So when we look at the growth rate, we're going to look at historic, and then we're going to look at the analyst consensus of how they're going to grow. So they've been growing really nicely, right? From in 2024, they grew by 21%. They had kind of a plateau year in 2023, but the year before was 34%. So that looks good. Looks really good. So it's about a 20% grower. When we hit the quarterly, yeah, it's growing at like 18%, 18%. So it's looking good. Okay. So 18 might be a good number. 15 might be a good number for future growth. So we know that's history. That's looking backwards, but let's look forwards. We have one analyst, one brave soul who says, hey, these guys are fairly priced. Not enough data. Now, there are more analysts doing a forecast on cash and earnings per share and so forth, and quite a number of them. And the company is expected to grow 15.6%, very doable. They're growing at like 18% for the first quarter, and then 10%, 7, and close to 8. All right. So in my head, I'm thinking cash flow can grow faster than revenue because they have scale now. They're pretty big. So they could add more revenue, and it's more profitable revenue. They don't have to rebuild anything at the airport. They're just doing more volume. So that's good there. And then we'll hit it with 4% growth rate in terminal value. So based on a 15% growth rate in years 1, 2, 3, and 4, this is the forecast of cash. And then all cash after year 4 is going to grow at 4%. That's what we refer to as terminal value. Discounted at 11%. Okay, that's a very good rate of return, but we're taking a higher risk. We're down to Mexico. The current net present value on all those cash flows is $10,491,000,000. We're going to add cash and take away debt, and I think they were kind of about the same amount, so that shouldn't really move the valuation very much. So $1,050,000,000 and then $1,150,000,000. The shares outstanding on the stock, 300 million shares. Okay, so we have cash, equity value. So the stock price is, why is this not updating correctly? 304 USD. Okay, that is correct. And so I know their market cap is 9.12 billion. So what is not jiving here? 300 million. Okay, so I'm gonna divide the stock price into the market cap, and then we will get to the the market shares outstanding that are being used. So 9. Yeah, that's what I figured. 30 million. So they're just kind of like the way they presented the data was not correct. So it's a 12% discount. Okay, let's move on to earnings per share. And the earnings per share that was on here was, now I'm going to use fiscal year 2026. And is this in Mexican? Yeah, this is in Mexican currency. So I'm going to have to multiply that times the rate. It's supposed to grow pretty much 11% going forward. Okay. So 50.63. So it's $2.68. Okay. All right. This is a good growing business. It's outside my home country. It's an airport kind of infrastructure. So let's go with the 12, and then the growth rate was supposed to be about 11, so I'll go with 10. And something went wrong here. So again, we're getting kind of these funky numbers. So let me check back and see. So this is presented in Mexican currency. Okay. Yeah, the PE is really high in future months. So the PE isn't going to get us there. The free cash flows look okay. The PE doesn't look good. And then the blended is like 20%. Yeah, this one isn't like investing down in Mexico is higher risk. This one doesn't make it for my decision process. The reason for it is like if this was in the US and it was more like, hey, you're investing in like a real estate investment trust or something that's lower risk, maybe I'm willing to say, okay, maybe a 25% discount is really good. But in this case here, there's just not enough discount available. So I'd probably pass on this one. So yeah, so thanks for asking about this one. Let's move on to the next one. And it's FER, Ferrovial. Ferrovial and its subs engages in the design, construction, financing, operation, and maintenance of transport infrastructure and urban services international. It operates through 4 segments: construction, toll roads, airports, and energy infrastructures mobility. The company designs, executes various public and private works, including construction of public infrastructure. Okay. So these guys are an engineering and construction company, okay? Different than this company. This company was the actual owner, okay? The actual owner of an airport and air services. 2 different animals, right? It's like if you look at a hotel property, there's a company that built the hotel, then there's the hotel owner operator, 2 different businesses. The construction companies get paid once to build the hotel, and the hotel operator is going to be paid all the future revenues. 2 very different businesses. This one representing more of the hotel operator, and this one being the construction company. So these guys do that type of work. Construction companies don't carry big valuations. was actually having a conversation, a brief one, with my son around a company by the name of Fluor. And Fluor, I know because they started in Irvine, California. And when I was a little kid, they had a cool building that was just basically architected to look like a American football helmet. And I thought that was kind of cool. If you're 20 years old, you think stuff like that's cool. So I always remember Fluor. And they moved from Irvine, California, to Houston, Texas. So that company I've known for a long time and I've valued a couple of times. Market cap for this company is 36.5 billion, 10.98, so 11 billion. So 3 times, a little more than 3 times revenue. You see these PE ratios? This is construction. And construction has ups and downs. It's, they have a boom of construction projects, and then man, they don't have, it seems. Looking at the 5-year, this is done really well for a construction company. This is very consistent. Very nicely done, guys. 28.63 in the 1 year, 67.66, and they pay a dividend. So this has been a fairly good upward trajectory on the stock price. And then you add maybe 8% for that dividend. So you're up to 75%. And where are they headquartered? So the Netherlands. Okay. Got it. In Amsterdam. Okay. Got it. All right, let's take a look. So a couple of things that I expect. Low margins. And cash flow is going to be low as well. They've been a grower, very good. I think that stock price has been consistent with their growth rate. Maybe they build these projects and then they establish maintenance contracts, because that's pretty consistent revenue. That's very good. Nicely done. Sometimes you see these construction companies and you have a big number 1 year and then a smaller number the next year, and you have kind of a decline in revenue, but it's not the case here. All right, so free cash flow has been a little up and down. It was nice back here, came down. Now it's back 925 million. And then gross margins, they actually have very high gross margins. Interesting. These are great gross margins, 87%. That looks good. Okay. Now they're not keeping a lot of it in operating margin. Profit margin looks good. Free cash flow of about 10%. Okay. Huh. I'm surprised by that cash flow. This is in the euro, and I think the euro is a little more valuable than the US dollar. So 1 euro is $1.16. So we'd be adding about 16% to these numbers if we wanted to think about them in US dollars. So this number is actually 16% more. So that'd be like, call it 1.5 million more, billion, excuse me. So that'd be closer to 11 billion in the trailing 12 months. All right. Now, doing it kind of back of the napkin and looking at their cash flow. So 925 plus 16% it's going to get us to about to about 1.07 billion. And for this type of business, I like their margins, high margins. That looks really good. Their growth is good, consistent. It's not wildly like a high grower, but it's consistent grower. I would say you could probably pay 20 times cash flow. That'll probably get us to about 21 billion in value, at less any debt. So 21, let's keep that number in our heads, less debt. So when we look at debt, they do have some debt, like $8.82 billion of debt. And one way to determine, is that a lot of debt or a little, right? It depends on the size of the company and how much revenue they're producing and how much earnings before interest, taxes, depreciation, and amortization, EBITDA. 7. That's way too much. You can think of this as it would take them 7 years to pay off debt. That's too long. 7 years. Okay. I want this to be a maximum of 3 years. 3 years is manageable. If you stick to it, you can get through it. But if you used all your cash and all your earnings to pay off debt for 7 years, you would deplete your business. Your customers would go away. They'd be like, oh man, these guys don't pay attention to us because they fired all their customer service people. They fired a bunch of people that used to service our account. So that kind of behavior would be punished by their customers. So this one here, the debt scares me. The valuation isn't very good. Why is that? You know, what's great about stock investing is we have choice. And when we look at all the stocks that are out there, it's thousands, like 5,000 stocks. And I'd rather go to stocks that are really desirable. Desirable in two ways. And I'm going to open up a file that'll help me explain this piece, because this is an important piece. Sometimes, you know, we understand a business, but at the end of the day, businesses are different, right? Let me show you an example. For example, a business that we all know and like, and probably like, I should say, is see if Microsoft, right? Everybody uses Microsoft. They had good earnings. So they constantly grow. They're really strong growth company. They have a strong moat. They have intellectual property in their products, whether it be their software products. They have a very strong moat around their cloud business. Once customers go into their cloud, they pretty much don't leave. So they have just a lot of IP. They have Activision over there. They have Twitch for you gamers out there. No, not Twitch is owned by Amazon. Sorry, they bought Activision. That's where they are for gaming. Now, they have proven that they can grow and they can grow profits and free cash flow. They have high margins. So when we look at Microsoft, they have outdone their competition, just blew them away. They're just better, and they've created this powerful network effect. They have a super strong balance sheet. They drive a lot of revenue growth, very profitable, and these guys produce cash flow. It's insane how much cash they drive. So this is a very valuable business. Now let's talk about a business that I think is really undesirable. Macy's. This is a retailer. 100 years ago, this was a cool business. Today, not so much. Their revenues keep going down. Do they have a moat? No. Amazon is killing these guys. Big box retail is killing these guys. Their competition's immense. They don't have any barrier to keep competitors out. Their customer isn't sticky. A customer is just going to shop around. They want to buy a new pair of whatever or a new product. They don't go to Macy's first thing. They go on the internet, search around, and find the best price, and voila. They are not growing. Their profitability is razor thin, and their cash flow is up and down. So Macy's, on the other hand, from a competition perspective, maybe they are a good retailer, but they barely get a passing grade. They don't have network power. They don't have a good balance sheet. Revenue is contracting, so I'm going to give them a D there. Profitability is suspect. So this report card isn't looking too hot. So these guys are here. I want to invest here. I don't want to invest here. And we have thousands of companies to pick from. Now, we talked about this company here, right? And some of the numbers look good. Some of them don't look good. It looks like it's priced too high. Now, I have to remind myself, where would I put this company, right? They are a slow grower. Are they going to be able to accelerate their growth? I don't think so. I think they're just going to keep, going along, growing, mid-single digit. So it's going to be kind of people that know the company are probably going to invest in it. Where would I put these guys on the desirability? Well, let's go ahead and do that together here. So competition, can other businesses compete for these projects? Probably. These guys probably have expertise. So I'm going to give them a B because they probably have expertise. Hey, we've built toll roads, over here, over there. We've got a really good resume. Okay, cool. They probably have a reasonable network power. Balance sheet, I'm going to give them a D. Not a good balance sheet. Showed you too much debt. Revenue growth is decent. Okay, got to give them a B there. Profitability looked good. And I'm actually going to give them an A on profitability. Free cash flow is decent. So this is not like, we got a problem student here with a lot of C's, D's, and F's. They got a couple B's in there and they got to work on that balance sheet. So these guys, I'd actually put probably around here and say, they're investable, but stock market, you have to give me a compelling discount to be an investor. Because I could buy Microsoft at fair value. I could buy great businesses at fair value. I can buy Uber at a discount. Talk about transportation. I'd rather own Uber. They're growing fast, dynamic, better cash flow, all kinds of good stuff. I get to choose from thousands of businesses. So I don't want to lock in on a business that's maybe going to do okay. And it would be a pass for me unless, let's say, this stock continues to operate really well. They get their balance sheet in order, and it was trading down. And next thing you know, the market cap's 15 billion. And we think, well, now they're worth about 25. All right, now we're talking. Because it's out of my home country. I'm in the US. This is the Netherlands. And there's just too many things there that it would cause me to discount the value of the company. And again, it's because I have other choices. I'd rather go invest in Uber. Talk about transportation. These guys are a transportation company. And these guys are growing faster. Look at that dynamic number, right? I have a choice. I can invest in Uber. I can invest in that company in the Netherlands. And these guys are valued much higher, but you see their revenue is much higher. Their PE ratio is at 15. When we look at how much faster they're growing a big number, 45 billion. Let's look at their cash flow. Cash flow's beginning to get insane in a good way. 7.7 billion. You see how it's grown from 300, 395, 3368. So we want data to kind of have an upward trajectory. So here's a stock in transportation. I think it's currently discounted. It's a terrific stock. And just remember that as you look at companies, there's no rule that I have to buy. There's no rule that I even have to buy Uber. It's my choice. So I want to do my homework. I want to say, all right, Uber, what's the story on the value of your company? Once I do all my homework, and you're a member of the channel, Mitch, you have access to this, by the way, on the shared folder. There's a sheet that has all my valuations and research, and you would have access to this. But when I value the company, just like we did before on those other businesses, I get much higher value and a much better discount. So now I'm left to big picture. Do I think Uber is going to keep growing? I personally think they are. I think they have a business that's made for the future. I think they own a good part of the future. Robotaxi is an opportunity for them. They do food delivery as well. So I think they're going to do well, and they're delivering awesome profits. Cash flow is coming out of their ears. So they are discounted. This is a much better proposition for me. And I would put Uber, coming back to this little graph, I'd actually put Uber in the green with Microsoft because Uber is different. They're number one in rideshare. They're as big as DoorDash on food delivery. Their brand is super strong. Like I only take Uber when I travel. I think my sons take Uber, my wife takes Uber. We're comfortable with it. That's creating network power. Their brand, they outperformed Lyft. Nobody else in the US is even close to Lyft. Balance sheet is exceptional. We didn't go over that, but I can assure you they have more cash than debt. Revenue is growing really fast for a big company. Profitability is there and cash flow is there. Straight A student, go Lip. So these guys are in the green and they have a nice discount. So we have choices. Let's go pick the best businesses that are going to make us the most money. They're going to be the most valuable companies in 5 years, most valuable companies in 10 years. Okay, so good ones, Mitch. Hopefully that was interesting to you and useful. All right, we dug deep on those. Dug deep, try to find some gold. Dre the Great. Okay, so any thoughts on cybersecurity sector? Yeah, I like the sector. I liked it more when it was priced lower, but I think that, one of the things that I see is the sector is very competitive. It's not like Microsoft is an example. They've been around for 19, when were they founded? 76, I think, maybe 75. So they've been around a long time. Their products stay around for a long time. I mean, I've used Excel forever, and now I use Google Sheets, but you guys get the picture, which is their products just keep getting used year after year. Well, if you go back like 20 years, cybersecurity, the leader that was the leader of cybersecurity 20 years ago is totally different than the leader 15 years ago, different than 10 years ago, different than 5 years ago, and now it's like CrowdStrike and these other guys. They're going to get leapfrogged because the threats continue to evolve. The hackers don't like, oh, hey, this is how we used to hack into computers in 2015, and now all the cybersecurity software prevents us from hacking. They're not going to do that anymore. They're going to move on to the next thing. How can they hack in a different way? Well, that type of intrusion is going to be covered probably by another business, another innovative business that says, okay, we know how the bad actors are acting now, and we're a better company. You saw that Palo Alto is acquiring that small company, and they're doing that because Palo Alto is feeling the heat. Palo Alto is seeing that, hey, their stock was really struggling, and I called this one out. I have videos on my channel, so you guys can check my comments. I said Palo Alto is too expensive at certain points, and it really hasn't performed well for probably about a year and a half. 6.5 as an example, and they don't pay a dividend. For a technology stock, that's not very good. So now they're acquiring a business to see if they can get their growth going a little higher. Okay, and they see that, hey, we're beginning to get less relevant in the marketplace. That happens in cybersecurity. So, it's a long runway for CrowdStrike's probably going to be good for the next couple years, maybe 5. But be aware that there'll be somebody who gets to be like somebody that's better. And the other threat to these independent cybersecurity companies is the big guys, Microsoft, Google, Amazon. They want that business. They'll create or they'll acquire. Google acquired a cybersecurity company so that they could offer their customers that run on their cloud their cybersecurity portfolio. And then they don't have to buy from CrowdStrike and Palo Alto and everybody else. So that's my spin on that. I made a little bit of money on Zscaler. I thought Zscaler was the best priced cybersecurity stock about a year ago, and it really did well. That was the one that did the best. I called it out back here, got videos on the channel. I don't think you want to watch them because it's like watching reruns of a show that happened in the past, but I did call this one out. I thought this one was the best priced, and now it isn't the best priced. It's gone up nicely. So I made a little money on this one, got out, and it went up higher than when I sold, but I made some money on it and made the right call. So cybersecurity, it's a pretty hot space because it's easy to get your head around it. But there's other businesses too. All right, my buddy Shadow Guy. That was a great call earlier. Man, we went like an hour and a half on the member call. We talked about some really good topics. And we really beat up the topics well, meaning we had different points of view. And that's really productive because I was able to learn something as well as, I think, contribute to the conversation. Awesome. Mitch, awesome questions on stocks. Keep them coming, buddy. The goal is just to become better and better and better, picking better and better companies, getting better skill set of how long to own them, how to analyze them again, make sure that we have a healthy stock, meaning they continue to grow, they continue to have those characteristics that make them valuable. And you got to pick your lane. I'm a long-term investor. I want to wake up 20 years from now far wealthier than I am today, and I'm really working on a long horizon. I make plenty of gains where I can fund a very comfortable lifestyle. Don't get me wrong. But there's also other investors that are like, hey, I want to make a lot of money by the end of the month. Well, that's not my lane. That's somebody else's lane. They can go options. They can go all kinds of uh, creative things. And I'm not going to say that's right or wrong. I'm just going to say the lane that I think is going to be best for me is to just continue to take my capital and compound it. Have it grow really well this year. It grew really well in 2024. It grew really well in 2023. Just keep compounding it. Keep that mass growing to the point where I'll have enough gains where I won't have enough time to spend the money. That's the goal. Just keep making it so big that I can take care of my family and leave it to my kids. So that's my lane. Okay. So if you want to get on that lane with me, stick with this channel. We'll find really good businesses, and some of them hit in the near term. Some of them hit over some course of time, but most of them hit because we're looking for quality. We're looking for the right fundamentals. We're looking for stocks like Zscaler, right? These guys were growing as good as their competition, even you can say better. So when I started saying these guys are discounted, we were seeing this data set. This data set looks good. And for some reason, the market thought, remember I showed you Meta, the market for a short time was kind of out of its mind and discounted Meta so bad. Look what it did to Zscaler. The market will present opportunities to us. It'll say, hey, Victor, knock, knock, who's there? It's the stock market. What do you want? I'm discounting Zscaler by 75%. I go, oh, okay, I thought it was the food delivery guy delivering a pizza. No, the stock market down 75%. What do you think? Well, let me get cracking, because how are you discounting a company that is showing us these fundamentals, this growth, but the market's doing this to the stock? So there were some stories out there that were more fiction than fact. So I was able to address that, and then, hey, this is a good stock. Okay. That's the lane that I'm in. Find good businesses that have a good proposition, they're growing, they're profitable, cash flow, and be patient and be wise and buy them at the right time. Make some money, decide what your exit strategy is, and that's the recipe. Sometimes a recipe like Zscaler, a nice 25% gain amount, short term success. Sometimes it takes a little while longer, but you make a bigger return. It compounds. Some of these stocks compound. It becomes a 3-bagger, 4-bagger. Those are very satisfying. And along the way, you pick some dogs, some companies that you thought looked really good, but then they started to perform very poorly. The sooner you can address those, the sooner you can get them out, the better. So, all right, we are cooking with gas. Dre the Great. All right, cool. So we are rolling. So let me know if there's anything else you guys want to talk about. We've got about 15 minutes left in the stream. I've got dinner plans, so that's why we're going to have a hard stop tonight. And I wanted to keep going on the list of companies that are going to announce. And my friend Shadow Guy is on the stream. He's bought Palantir at the right time. He's flourishing with this stock. I mean, look at this thing. It's up 2,000% over the 5-year. Man, this is in the positive but ridiculous zone. And something I learned, I always treated uh, I always treated Palantir as a software company, but I now realize that I was wrong in not addressing that the way they use their software to do the surveillance and kind of, they call it AI. They can call it AI. It makes sense. It's AI. And it enables, either companies to find certain conditions and then take action, or like the shadow guy sent me a good article on, I think it was the German police is using it, and they can quickly ID people, and especially suspects or people that are wanted. Like, we know that guy robbed a bank. We know this is what he looks like, and so forth. The Palantir software will help law enforcement find that person. That is pretty valuable. And they are growing really nice, and their growth is accelerating. See how it's going from 29, 30% to 36 to 39 in the quarterly. Well, that's a really good sign. That means they're growing faster. Customers really like their software, really like their technology, really like their AI. So much that more customers are buying it. The current customers are buying more. They have terrific margins. I think their margins are close to 90%. No, 80%. And they're not gigantic yet. They're a couple billion, $3 billion. So they're not gigantic like Microsoft and so forth. As they get bigger, the profitability will get bigger, like operating margins, profit margins. Free cash flow is very good. That's when you deal with technology, software, semiconductor, you get these high margins, and they create very valuable companies. So this one, kind of like the boat, I missed the boat on it. The balance sheet's good. And what are forecasts saying? 18 analysts. Okay, let's see where everybody's at. So man, we got them all over the place. We got an analyst that's saying it can go up to 178, and on average $100 stock, so it's priced 35% too high. Then we got a guy out in Siberia somewhere saying it's a $21 stock. I don't agree with $21. Do I agree with $100? I don't know. I'm going to show you my valuation later. They're going to keep growing. So they're going to be close to a $10 billion business in 2028. That is pretty impressive, by the way. And some things that are kind of hard to fathom is a PE 638. It's like, what? 100's a high PE. How could you have a PE that's 638? Holy smokes. That's big. So that's a symptom or a clue that this might be a little expensive. All right, so Palantir is going to announce tomorrow. I'm going to do a watch party for Palantir because I think it's a pretty awesome company. Needless to say, I mean, look at this rate of return. Holy smokes! What a rate of return, huh? That is like Nvidia, Palantir. These stocks have just been killing it. Congratulations, Shadow Guy. Congratulations, everybody who owns Palantir. And where are we? Where's Palantir? So I think Palantir is really priced too high. I look at their cash flows. I try to grow them rationally. I'm going to take their financials tomorrow, and I'll do my best to get the valuation that I think that should be put on the stock. But I've been wrong on Palantir to this point. I just got to figure out how I was wrong and try to learn something, because I certainly missed this one. It's not like I didn't know of Palantir. I knew about Palantir. Shadow Guy is not the only friend that is in Palantir. I got a friend that I've worked with him for 18 years, 17 years, and he's so proud. He got Palantir at like $40 a share or something. He's very proud of it. Good for him. Good guy. Works hard for his money. So that's Palantir. So Hood's come up a couple of times. So Michael Anthony, what's up, man? You've been on my stream for years now. Looks like very overbought. Yeah. We've been saying that about Palantir for about a year and a half, and it keeps going up. So it's like, okay, something in my logic, my analysis is off because the stock keeps going up. So a couple people wanted me to comment on Hood, and I did a video on Hood. I encourage you to watch it because it really put a lot of effort into um, doing videos on companies. And I'm a big Robinhood investor, by the way. I've done really well with the stock. This one, really over the last couple years, it's really gone up. And this one on the 1 year, 385. I like this graphing better. Gives me a little more room to roam. So buying Robinhood at the right time was a very good thing. I started buying in Robinhood and the whole story. It's doing really well. And the earnings were fantastic. Okay. Now, the stock, they announced, and you see how this kind of came down and then it came back. Because I think investors were confused. They were dazed and confused, like Led Zeppelin would say. And let's take a look. So I'm thinking of that bass line that John Paul Jones of Led Zeppelin would start playing for Dazed and Confused at the beginning now. So these guys grew at 59% trailing 12 months. They grew in the quarter 45%. These guys are getting big, okay? Robinhood is. We're up to $3.5 billion in revenue. Okay, we're not talking chump change anymore, and they're growing nice and fast. And they're picking markets where, like the prediction market, right? You're gonna be able, you can bet on Robinhood, like you're gonna be able to bet football games. Like you can't bet like all these, fancy bets like, oh, so and so is who's gonna score the first touchdown and under overs, but you can. They're prediction markets. I bet that the Eagles are going to beat the Cowboys. You just bet on the final conclusion, and that's that. So they're going to have that business. They have the tokenized business. They're going to have tokenized assets like stocks on their platform. That's a really good idea. Of course, they do crypto, stocks. They do a lot of savings now for investors. They're trying to grow within 401k money, which is a really good idea, and threatening the established companies. So these guys are killing it. Strategy is solid, and they're growing really well. And when we go to profitability and free cash flow, $4.5 billion of cash. Awesome. Nicely done. Operating margin, 42%. Profit margin, 50%. 50%. These are just like awesome numbers. Okay. And balance sheet's awesome. I think their strategy is disruptive. The strategy is getting it done. And I looked at the numbers and I created a video with it with more details than I'm going to offer here on the live stream. And now I think that I'm back to a discounted Robinhood based on the new fundamentals that I'm seeing. And I called out Robinhood 2.5 years ago saying this thing's discounted. Here's why. Here's the valuation. Now I'm back to that because their cash is just going through the roof. So I'm back to a discount and I'm back to buying Robinhood. And this is the third biggest position in my portfolio behind Meta and Google Alphabet. And it got there through appreciation. We've done really well with Robinhood. And I think it's just going to keep going up. So that is Robinhood. Nicely done, Robinhood. Keep going up. Okay, so looks like we got 5 minutes to go. All right, so Shadow Guy. Yeah, congratulations, Shadow Guy and Palantir. Try to study how you knew that was a good stock and go find others like that. And do me a favor, tell me about it too. All right, Dre the Great, Zeta. So we looked at Zeta. When did we look at Zeta? We looked at Zeta. Carlos, thanks for becoming a member. You're a longtime viewer, man. That is awesome, dude. Please get me your email address by emailing me at victorhinvesting@gmail.com. It's the channel name, victorhinvesting@gmail.com. Get me an email. I'm going to give you access to the member calls, get you access to the shared folder of assets, including my research, and get you access to the Discord. And then obviously now your name's going to come out different when you come to the streams. It just pops out differently and I'll know you're a member. Thanks so much, man. It's been great to have you on streams. You've had a lot of good questions and I look forward to, getting to know you a little bit better. So thank you. So Little J, I just joined. So yeah, I think you missed a couple of tech stocks. I think maybe watch the recording. It'll be available on the channel. So we talked about Uber. We talked about Palantir. I don't know. Robinhood's a tech stock. We talked about Zscaler. So we did talk about a couple of tech stocks there. So you might want to watch the recording. So awesome, Carlos. Great to have you in the community. Thank you so much. Awesome to have you. And Jonathan, thank you. Thank you for joining and thank you for the comment. It's encouraging. But Dre the Great, we looked at Zeta and I know we looked at it recently. I think we came up empty. So Zeta, omni-channel, yeah. Okay, cool. These guys are like AppLovin, if I'm correct. And what we found was, I'm not sure if I'm following it because we looked at this one, I think on Friday. Okay. So this is a marketing cloud. They help companies basically market now with all the different platforms that are out there, Facebook and Netflix and Amazon Prime and YouTube and all kinds of places. Their business is similar to AppLovin. AppLovin's probably the most successful company in this area. And let me see if I still have the valuation on them. But when I say we came up empty, like earlier in the stream, I talked about we have choices. And this one here did have a very favorable discount. They're just tiny. What was my go forward plan on this one? Because I'm gonna have to go watch the video because my memory is not serving me at this moment. So they are gonna announce on August 5th, and I think it was a matter of, so this is a smaller, smaller cap. We have businesses like AppLovin. AppLovin is bigger, okay, much bigger, 128, and they have 5 billion in revenue. These guys are gonna announce on the 6th. Zeta is pretty big. What was something that was a limiting factor? Gross margin, 60% is decent. Yeah, this all looked good. Looks good. I think I wanted to look at one more earnings and then make a decision there. But now looking back at the fundamentals and the valuation, it looks good. Just selling off, man, what the heck? Again, the stock market gets a little out of its mind once in a while. But we get earnings on Tuesday. We're going to hear from this company. If they can keep growing or even accelerate growth, we got something, right? We got something. If we're a little bit late to buying into this, no problem. This thing's going to go up a lot. It was up to $30 a share. So adds good earnings, it moves to 17, I'm buying. And then I can maybe ride things are terrible, right? And I lost some money. So this one was a good stock. This one was a very good stock. So, and just for you members, I'm going to do it late tonight, early tomorrow morning. All the valuations, I've put a lot of work into the valuations over the last couple of weeks, and I'm going to update what I share with the community, and then you guys will have the new research in the next 24 hours. Just time got away from me. Went to the movies, saw the new Naked Gun movie. It was really funny. I saw the original and really liked it. Good humor, and this one didn't disappoint. Thought it was funny. And now I'm gonna get myself ready to go to barbecue. So awesome stream, everybody. It's great to have you for an hour and a half. Thanks so much for tuning in. And I'm gonna stream quite a bit this week, like I did last week. Tomorrow, I'm gonna try to stream as a watch party for Palantir. I'm gonna see if Daryl can join me because he's brilliant on technicals. And if you can join me, that'd be awesome. Or you can join me later in the week, or you can join me next weekend. All right. And consider being a member. It'd be great to have all you guys as members. I have more people on the member calls, and I have more people on the Discord as well. So think about it. Go to my home screen for the YouTube channel. There's a join button, and you can get more details there. All right, everybody. I'm signing off. Everybody have a great night. Thanks again for tuning in.